Welcome back to the channel, everyone. Today I can't really believe what I've just heard. It's Vlad Tenev telling everyone that he had a call with the NSCC to discuss turning off the buy button to reduce that $3 billion margin requirement that he had to meet. And then a little bit later in the video, I've got an investment banker who says that AMC 500k is not a joke and it is absolutely a possible flaw. So stay tuned and let's make some money. But guys, before I dive into the video, I just want to give a massive shout out to the 3,900 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell if you haven't already, so that you don't miss another video just like this one. And just a quick one before I dive in with the key information. If you didn't already know, I'm currently holding a $600 giveaway and I'm drawing the winner on the 28th of August. All you have to do to be in with a chance of winning is join the Patreon linked in the description below, and you also get a bunch of other benefits while you're over there. And now I want to dive straight in with the key information. So, let's hear what Vlad Tenev had to say.
Our chief operating officer basically said, look, let's call up the higher ups at the NSCC and kind of figure out what's going on. Maybe there's some way we can work with them. And basically there was another call and they lowered it to something like $1.4 billion from $3 billion. So, okay, we were making some progress, right? And then, but it's still a high number. And then we basically proposed, well, let's explain how we plan to let's explain how, we'll manage risk in these symbols throughout the day. We proposed marking these volatile stocks that were kind of driving the activity, position closing only. And then at about an hour before market open, so 5:30 or 5 in the morning, they came back and they said, okay, the charge is, or the deposit's $700 million, which we then deposited and paid promptly, and then everything was fine. So that essentially explains why we had to mark these symbols position closing only.
So if you didn't quite know exactly what that was Vlad Tenev talking on a ClubHouse stream with Elon Musk and a few other people. That was Vlad Tenev admitting that he planned to turn off the buy button on AMC and GameStop, and the reason why he did that was to manage risk, so that the DTCC would drop their margin requirement from $3 billion down to $700 million. Basically, Vlad and Robinhood screwed over millions and millions of investors buying AMC and GameStop stock. Also, Vlad could reduce his margin requirement position down from $3 billion to around $700 million. Just to note, the NSCC denied that under oath, and CNN even glossed over it. I'm very impressed that someone managed to screen record and voice record the entire discussion, and also very impressed that I managed to come across it. That is absolutely ridiculous that Vlad Tenev could just have a conversation with the NSCC and plan something potentially very, very fraudulent, as it screwed millions of investors over, just so he could decrease his personal or his company's personal margin requirements. I think this links in quite nicely with the next post that I want to talk to you about how the NSCC could potentially try and manage this squeeze. There's a post here from Trading Tradesman saying no one understands how this works, and many shills will say I'm wrong, but allow me to give you some background. I've worked in the banking industry from 2006 to 2011. I graduated from Wharton in 2000 with a degree in analytics. My first job was at Bank of America, downtown Orlando, followed by Owen Federal Bank from 2008 to 2009. Now, I guess I can't prove the legitimacy of this post because I don't know the guy, I don't know his personal employment history, and you also don't really know at what position he owned at Bank of America or at what position he worked in. He could have been an investment banking VP, senior VP, or managing director, or he could have just been the janitor that cleans the bathrooms, for example. However, let's assume that he knows what he's talking about, and let's carry on. But let me get to the point, and I'll keep it as smooth-brained as possible. Shorts on AMC are screwed. The system has been playing hot potato with risk, selling risk into the market, so risky investors hold bags of rubbish. In order for market makers to balance the books, they need to buy and burn billions of shares. The reason why they need to buy and burn shares is because obviously they've created all these synthetic shares, and they first need to buy back the synthetic shares and effectively delete them so that they can get back to the true float, and then buy the true float to cover their shorts. If no one sells, the squeeze will halt at a price cap set by the DTCC. This could very much be the DTCC stepping in to make sure too many hedge funds and too many institutions don't get liquidated and crush the financial system. Yes, they have put processes in place where long positions can be loaned out for cash, and that cash can be used to cover short positions, and therefore they don't crash all the big stocks by selling off their long positions. However, at the same time, these short positions might be so big and so heavily leveraged that even by lending out their long positions, they might not have enough cash to cover the shorts. Therefore, the DTCC may step in and set a theoretical limit on the AMC and GameStop stock prices to make sure that the DTCC themselves don't end up spending too much money or digging too heavily into their insurance policies. Obviously, a lot of cash as collateral is given to the DTCC, such as in Rule 005, where $250,000 is going to have to be deposited with the DTCC per institution, per trading account. However, who knows whether this $250,000 per account per institution would realistically be enough to cover the AMC squeeze. If it isn't, the DTCC is going to have to dig into government money, effectively taxpayer money, to pay off the GameStop and AMC squeezes. Therefore, it's only reasonable that the DTCC would set some kind of limit cap to make sure they don't need to pay out too much money. However, he thinks it will be well over $1 million. If every paper hand sold after that initial halt, be prepared for cash out limits. The price will not drop, but go upwards. Shorts bought the sell-off and burn the shares. Round 2. Halt at a lower, ridiculous price. We hold, the price spikes, more paper hands. Shorts buy the sell-off again and burned all of those shares. Share burning will continue until all of the shares are accounted for. If no one sells, the price will glitch but will continue to rise. If everyone paper hands, every institution, every hedge fund, every index fund sold off AMC at $300, shorts would still need to buy back and burn over 900% of the flow. 500k is not a meme. 500k is the floor. Basically what he's getting at is that obviously AMC is almost going to squeeze in stages because of the market halts. Therefore, when the squeeze happens, it may squeeze to say $100 to $200, and then paper hands are going to sell their shares, potentially causing a small drop. However, this drop is going to be bought up by the shorts, all covering their positions and getting liquidated and needing to go into the market to buy the stock in order to cover their short positions. And then because those shares being purchased are really just synthetic shares and not actually real shares, they need to be burned or effectively deleted. Therefore, it will almost count as if there's been no shares purchased because the real float won't yet have been sold. Therefore, the AMC price will continue going upwards and then will halt again. And then when it reopens from the halt, much higher, again you're going to have a second wave of paper hands selling off more of their shares. And it'll effectively continue going in stages of halt, open, small sell-off, rise back upwards, halt, open, small sell-off. Continue going in stages until all of those shorts have covered their positions. And therefore this guy thinks because of how many synthetic shares there actually are, that AMC will squeeze to well over 500k a share. Another poster says, Apes, I may have found the reason for AMC's recently bullish price action and why we could be insanely close to the mother of all short squeezes. For the past week, the price action has looked like this. This is a screenshot of AMC, unfortunately from Robinhood, but just look at how good that graph looks. 4 days in a row of significant positive growth, 2 to 6%. I was looking through some old documents and remembered the rulings NSCC 002 and 801. Under NSCC 801, hedge funds must report their short positions versus their money on hand. If the margin exceeds the cash collateral that they have, the NSCC can force them to cover within 1 hour. Therefore, hedge funds' ability to short will be at such a minimum level that our buying power will just break through their sell walls and the price will just continue to rise and rise until they can no longer afford to suffer the loss on their end and are forced to cover. If hedge funds choose not to go through with this route and cover their shares, the other outcome would be strong final blows of sell-off aggression and shorting, literally out of pure ignorance and recklessness, which will activate 801 and thus the greater fall of the hedge funds via a margin call. As he stated, the NSCC has these rules in effect, but will only really need to apply the rule, such as 801, when they're in serious need of liquidity. But what's happened recently? The NSCC accelerated the publication for NSCC 005, which increases collateral requirements by 25x for clearinghouse members. it looks like they really need liquidity right now. And we also know that because the US Treasury has been hemorrhaging cash like no tomorrow, losing between $20 and $30 billion a day, and they only have around $300 billion of cash on hand. In this guy's previous post on NSCC 005, he said implementation will be on September the 11th. That was my max conservative answer he could give, and in reality, it gets implemented no longer than 20 business days. For all we know, it could have been implemented already, potentially even yesterday. When it says no later than 20 business days, it doesn't necessarily mean on the 20th business day. It could have literally been the day after. 801 could have been getting enforced last week for all we know, which would explain this price movement. This is my theory at the moment. So far we've had 4 green days. Today is Wednesday. If we see another significant positive day by at least a few percent, that would further solidify the validity of this theory for me. So far we're seeing AMC trade very close to its opening price, but we are currently seeing a 5th positive day. I'm really interested to see how the AMC price holds up for the next hour or two of today's trading day, and seeing whether we close green for another consecutive day. This is also insanely bullish for the MACD, considering we're now seeing the 4th consecutive green day for the MACD. The last time we saw consecutive green days for the MACD was back here in May and June when AMC started its run-up. In terms of today's dark pool volume, we're seeing typical mockery of 67% of total volume going through the dark pool. That breaks down to 67.1% of trades going through the dark pool, 17.4% sweep orders, 5.6% block trades, and only 8.2% odd lots. Interestingly, we're seeing a swing towards sweep orders as opposed to block trades, therefore suggesting that institutions are starting to market buy or market sell positions as opposed to placing limit block order trades. The AMC short interest is around 18%, but obviously that's the short interest, not necessarily the shares on loan percent. The shares on loan is 105.97 million shares, and the utilization is at 90.49%. Guys, be sure to let me know down in the comments below what you think about Vlad Tenev calling the NSCC and asking to reduce his margin requirement from 3 billion down to 700 million for the promise of turning off the buy button and managing risk. And as always, guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!